welcome to Dialogue. The International Monetary Fund has warned that the U.S. government debt of $35 trillion is putting the entire global economy at risk. But as the elevated debt sends fresh worries to the global market, both Democratic and Republican lawmakers are unusually quiet about the issue, even during this election year. How will the mounting U.S. debt affect the global economy? Can the U.S. fix its problem anytime soon? And what are the consequences if the U.S. is unable to repay its debt? Join us for discussion today, live from Beijing. I'm Xu Qianduo. Joining me today are David Goldman, Deputy Editor at Asia Times, Professor Iain Begg at the London School of Economics and Political Science, Radhika Desai, Director of Geopolitical Economy Research Group, and Kathleen Tyson, Founder and Chief Executive at Pacemaker.Global. Welcome to the show. So Kathleen, I will start with you. We know that if you have too much debt, it's not a good thing. That's common sense. But then $35 trillion, how big a problem or how serious is it?
Well, we don't know. We don't know how much debt becomes unsustainable. 35 trillion is about 10% of the 315 trillion in global debt. So the United States proportion of debt is very, very high. But the United States economy is still about 20%, 25% of GDP. So as long as the US economy keeps growing, it's possible that that debt is sustainable. The United States funds itself in its own currency, so technically it can't default. It can only inflate the debt away.
Okay, it can only inflate the debt away. In what way? Are you talking about inflation?
Yes. Right now, the single biggest line item in the United States federal budget is interest payments on the debt. In the last year, as interest rates rose, interest on the federal debt rose above defense spending, above Social Security. So that presents a problem for the Federal Reserve called fiscal dominance, because it becomes politically less possible to raise interest rates to fight inflation, because it pushes the federal budget into being less and less sustainable. So under those conditions, you can have the central bank decide to keep rates low, let inflation heat up, and then the system becomes slightly unstable. And we don't know at what point there's a tipping point. Mm-hmm. It's hard to know. Japan has been running huge deficits for 30 years, quantitative easing, buying its own debt, all kinds of imaginative central bank policies. And Japan has stayed remarkably stable through that period.
Mm-hmm. Okay, Radhika, you are nodding your head. So, according to some study, 10 years later in 2034, the U.S. debt is expected to reach $50 trillion. As Kathleen has said, nobody knows, where is the taking point. Do you think but some people would say that's unsustainable. But, what's the like a yardstick, whether it's sustainable or unsustainable?
Well, I think that I personally would take a slightly more serious view than Kathleen does. The example of Japan is always trotted out as, Japan has such a much bigger debt. But the fact is, Japan's debt is held by people that are far more under the control of the Japanese state. Bulk of it is held by Japanese people, whereas the US debt is held in international markets. Now, mind you, most of the actors in this international market are US based, but at the same time, they are, they demand that they may demand that at a certain point, much earlier than in Japan, that this debt is unsustainable. So that's one point. The second point is that, yes, of course, if the economy grew robustly, then the debt would be sustainable. But I'm not sure. There's not much indication that the US economy can grow robustly. We were told that the Inflation Reduction Act was President Biden's big bazooka, that he was going to make the economy grow. This was industrial industrial policy. Neoliberalism had been rejected. But we just read in the paper just a day or two ago that bulk of this money is actually not being spent. Bulk of the projects are stalled for one reason or another, including things like labor shortages and so on and so forth. So it's not clear that the United States is going to be able to jumpstart growth. I mean, the fact is that for the last 40 plus years, the United States has been pursuing one or another variant of neoliberal policy, which basically relies on big businesses to generate growth and kind of does whatever they want in as a justification for growth policy, or as this becomes growth policy for the US. And this has not produced growth back then. The US economy is in a much weaker position now. It's not clear that it's going to produce growth. And I should say that the IMF has warned that debt is unsustainable. The Fitch, I think one of the rating agencies, I think it's Fitch, has downgraded US debt. So all in all, I would say that the position looks difficult. And I think you said something else which really matters here, which is that neither of the major political forces, neither the Democrats nor the Republicans, seem to have any plan, any seriousness about reducing the debt, whether by raising taxes or by cutting spending. I wouldn't personally favor cutting spending or cutting certain types of spending, cutting social spending. But of course, the financial press is going to ask for cutting social spending. That is only going to create even greater political instability in the United States. Meanwhile, billions and billions is going into subsidies to big corporations, etc., and tax cuts are even more responsible for this deficit than anything else. And I do not think they are going to be taken away. So I think it's really a set of very, very problematic conditions in the United States.
Okay, we will explore the possibility of like how to fix the problem later on. I'm sure we'll touch upon that. But David, you are following the U.S. economy, the global economy closely. Is that a concern to you, $35 trillion and mounting?
The question about debt is where it comes from and who is going to finance it. Where this debt comes from, in fact, is not, for the most part, subsidies to corporations. It's what are called transfer payments or handouts to individuals, which increased enormously during COVID as an emergency measure. But after the emergency, the Biden administration kept the rate of growth of payments to individuals at an extremely high level, which contributed to growth in consumption in the short term, but also added to the debt. I think this is a very poor way, a low-quality way of adding debt. So that's the main source of inflation. You give too much money to people, and there's not enough goods to buy with that money. And that's created a lot of discontent and a political reaction. The second issue is who's buying it. We have the idea that foreigners are financing the U.S. government deficit. In fact, foreign ownership of U.S. securities, U.S. Treasury securities, is not changing very much. The main financing of our $1.2 trillion trade deficit is coming from selling stocks, equities, to foreigners. Our tech stock boom is the basis of our ability to finance that debt, that deficit, in an orderly way. And if, for example, we have a repetition of the early 2000s where tech stocks crash, we could have a really serious problem. Now, the result could be a much higher level of interest rates in U.S. dollars, since most of the world uses dollars for trade and investment financing. That would be an enormous burden, and it would tend to push the world more towards other lower interest currencies like yen, RMB, and so forth. It would tend to de-dollarize, and that could create a vicious cycle in which the United States had more trouble financing its very large current account deficit. That could be a vicious spiral. We're not there yet, but that is certainly a risk.
Certainly a risk. Iain, I mean, looking at the U.S. debt, $35 trillion, from London, from outside the U.S., do you see that as a problem or potential problem for the country?
Well, I would start by saying, forget using the number 35 trillion, relate it to the size of GDP, because that gives you a far more balanced way of understanding debt and debt dynamics. The debt has gone up as a share of GDP, and that is the source of potential problems. but it's a long way from being unsustainable. The test of unsustainability is you cannot persuade potential lenders to lend to you to finance the debt. And it's by no means clear that that is the case for the US dollar. In the past, the US has been described initially by Valéry Giscard d'Estaing, a former French president, and later by Barry Eichengreen, a very well-known economist, as an exorbitant privilege. The US can pump out dollars and they are absorbed elsewhere in the system.
Mm-hmm.
The US is unique in this. No other currency has that capability. So I think we have to recognize that the US position is very sustainable in the short to medium term. Now, if inflation takes off, the denominator of that ratio changes positively for the US. I think that's what Kathleen was hinting at earlier. Nominal GDP goes up, therefore 35 trillion as a benchmark falls as a proportion of GDP. That too can create its own unsustainability because you then have inflation and you invite the monetary authority, namely the Federal Reserve, to react to this. I think it's far more useful to view this through a political lens and say, why is it that American decision makers find it so difficult to accept that fiscal policy should be more disciplined? Let me throw one number at you. The last surplus on the US public finances was, do you know? In 2001, at the tail end of the Clinton administration. And it's that inability of the system, Congress on the one hand, which wants to add to expenditure bills, presidents who don't want to raise taxes, presidents who want to cut taxes. This is a dynamic, politically induced dynamic that creates the ratcheting up of the debt level. All that said, it's still not an unsustainable rate.
Mm-hmm. But Iain, people are talking about this fact that for this year, the interest payment from the U.S. is expected to approach $1 trillion. Is that a burden or something to consider for the country?
Well, yes, it's a natural consequence of what's been happening around the world, which is central banks raising interest rates to try to deal with inflation. The expectation is that those interest rates will start to come down relatively quickly. And then it's about the debt management office, about how successfully it can manage the portfolio of debt so as to avoid excessive interest burdens. It's probably at its peak at the moment.
Mm-hmm. Well, Kathleen, the IMF, is warning that if this problem is not resolved, it could put the global economy at risk. I want your understanding of this statement, the remark here. In what way that will somehow potentially damage the global economy?
That's a very good question. One of Iain's colleagues at London School of Economics, Professor Charles Goodhart, and I have been warning since 2019 that the single biggest risk to financial stability would be dysfunction or illiquidity in the US Treasuries market. Not just because the Treasuries market finances the $2 trillion in increasing debt this year, but because US Treasuries are the core collateral in the global financial system for everything that every bank does, and all other bond markets globally, almost, not everyone, but almost all of them, price against US Treasuries as the risk-free rate for the 10-year bond, for the 3-year note. And so if there's dysfunction and a lack of price discovery in US markets, it communicates immediately to other global fixed income markets in seconds. And we saw this in March 2020 when effectively the US Treasury market became dysfunctional and illiquid after the COVID shock finally hit. And markets as far away as South Africa were disrupted immediately because they couldn't trade without a reference rate. So what's really, I think, a pressing and urgent need is to find ways to insulate against that risk. Now, Charles and I raised this with the Bank of England, and their response was, oh, yes, we've asked the Fed to look into it.
Okay.
The Fed created the problem, and the Fed made a committee. They made a committee to look at Treasury market function, and they brought back the two people responsible for making the problem much, much, much worse, in my view. So asking the Fed to fix the problem that the Fed's own people created by bringing back basically the arsonist to fight the fire is, I think, not going to protect other countries that need to insulate their economies from a problem in U.S. treasuries.
Mm-hmm. So, Kathleen, are you suggesting, what people would call like a multi-currency like a system or mechanism somehow to reduce their exposure to the U.S. or reliance on the U.S. dollar, so as to somehow?
The agenda's broad. Certainly, Russia and China have reacted to the sanctions put on Russia in 2022 by moving almost all of their trade into either ruble or yuan. And many other countries, 80 countries in 2023 resolved as a matter of policy to move to local currency trade with their trading partners. So trading in each other's currencies for bilateral trade. 80 countries, including the unanimous vote of ASEAN states. So that's one way to protect their economies, but that doesn't address the global financial and capital markets risk, because trade is only about $48 trillion annually, right? But the turnover in the interbank repo markets is $18 trillion a day. So 3 days of repo trading is all of global trade. The foreign exchange markets settle an average. I built CLS Bank, this one I know. I designed their systems. The foreign exchange markets settle 7.5 trillion a day in foreign exchange settlements in just 18 currencies. So, if there's instability in the collateral in the core systems of U.S. Treasury, that communicates to the repo market instantly as a margin call, making all interbank credit illiquid. It communicates instantly to foreign exchange settlements and clearinghouses that require on margin collateral to support derivatives positions and trading positions. So it's a systemic problem. It's not something that you can just do one thing to fix.
Mm-hmm. Okay, Iain, so obviously the UK and the European countries are also one way or the other affected by the US faction in terms of financial policy, the US dollar?
Yes, so there is a degree of separation for the euro in that it can pursue a separate policy on both debt issuance, which is largely at the individual country level, countries like Germany, France, and so on. But there's been a relatively new phenomenon of EU-level debt issuance. It's insulated in part from the US dollar, but what you have to recognize is dollar dominance. Something like 60% of global reserves are still today dollars, 20% or so euros, and then a handful of other currencies with relatively small amounts making up the difference. You don't transform that overnight. The dollar is not going to cease to be the benchmark for the global economy, not even overnight, over a 5 or even 10-year period. So I think Kathleen's right in pointing to the potential problems of instability. But I'm relatively sanguine about the possibilities here. I don't think we're going to see anything too dramatic happening unless there is a further round of, shall we say, cavalier policies by American administrations. And here there's an interesting dimension to all of this, which is that in other parts of the world, there's been something of a revolution in fiscal policy of trying to have much more fiscal discipline, of having separate bodies to monitor, what we call fiscal councils, and commitments to fiscal rules. Now, you don't really see any of that in the US. Maybe that's the underlying problem.
Mm-hmm. David, go ahead.
Yes, we had a mini crash in Japan on July 31st when the central bank said that it would reduce the rate of purchases of Japanese government bonds. Now, Japanese government debt is 260% of GDP. That's double our ratio. Half of the debt is owned by the central bank. And the moment the central bank said, well, we might slow down the purchases, the stock market dropped by 20% in 2 days. The problem is that, just as Kathleen said about the repo market, in a smaller way, Japan is a huge source of liquidity. There's about $2 trillion worth of loans against Japanese government bonds. And if rates were to go up and bond prices would fall, that would shrink and it would affect markets around the world. So we had a ripple effect out of Japan, which was quite terrifying. Then the Bank of Japan backed off. That's what will happen eventually, coming from the United States, if this problem is not addressed. I agree with Kathleen completely, and I also agree with Iain's point that this is not a short-term issue. Europe can't do very much. The political will to do joint debt issuance, so-called cumularization of the debt, really doesn't exist. So you've got the German market, which is fairly small for government bonds because they haven't had big deficits, and other markets which are kind of dodgy because they've had too much deficits. Japan has shown us how vulnerable it is, so you're down to the dollar. Now, of course, China has an enormous government bond market, but China has decided, for better or worse, to insulate its market from the world by maintaining exchange controls. So China is in no position to replace the United States as a global provider of liquidity until such time as it decides a different policy. That means that if you had such a crisis, what you'd see is the kind of emergency measures that were taken in response to sanctions, government-to-government swap lines to maintain essential trade, but real pain in asset pricing markets. So I would look at the Japan events of the first week of August as a foretaste of what we might get if the problem's not addressed in the U.S.
It's not something to envy, right?
No, not at all.
Radhika, I'm thinking about the worst scenario. And people would ask, whether there will be a point somehow, the debt is too high for the U.S. government to pay even. What will happen? If somehow, the country will be on default. The whole world will be panic, I guess. What do we know? Are we prepared for that?
Well, I think that one has to really, many of the figures that my interlocutors have pointed to are quite correct, but some of the dimensions are forgotten. For example, when you point to the size of the sheer role of the US dollar in international transactions, people forget that bulk of these transactions are financial transactions, and bulk of these financial transactions involve entities that are US based or based in Western countries and Japan and so on. Most other countries in the world operate through some or the other form of capital controls, and they do not have the same extent of exposure to these financial markets. And as countries more and more begin to use one another's currency for trade and real productive investment purposes and so on, their connection with this largely casino style operation will be reduced, and I think that process is already underway. So I think that's the first thing that one should understand. The second thing is that to say that there is no alternative to the US dollar and therefore the US dollar will continue to reign, I think this is also problematic. Historically, if you look at the US dollar's career as the world's currency, it has been an extremely rocky one. And since 1971, it has relied on a vast inflation of purely financial transactions, which really do not support the productive economy, but are predatory upon the productive economy. And it has been terrible, both for the US economy and for the rest of the world economy, and it has induced regular financial crises, after which some new bubble is created and so on. So I think that this has also led to many people to rethink, and the solution is not another country's currency replacing the US, but different types of arrangements, a bit going back to the principles, at least, of what John Maynard Keynes had talked about at Bretton Woods, with the International Clearing Union and Bancor, a situation in which one country does not essentially, one country's policies are not do not weigh upon the rest of the world. Also, I'd say a couple of other things. You talk on the one hand about the exorbitant privilege of the United States, but Germany borrows at a lower rate than the United States. So plus in recent years, particularly with China massively reducing its holdings of U.S. treasuries and making Japan the number one holder now, you are seeing a kind of an exit from the treasury market, and you've also seen the Federal Reserve having to intervene in the treasury market in order to hold up their prices, So I think and the Federal Reserve balance sheet expansion has included a lot of that. So I'm not sure that the whole point of exorbitant privilege really works. And when this phrase was coined by Valéry Giscard d'Estaing, the French were actually essentially saying to the United States, we don't want to hold your dollars, give us gold instead. And the equivalent is that today a lot of Russia, China, etc. are in fact stockpiling gold. There are several other things that one could say. I mean, one is that the Federal Reserve at the moment is in a big dilemma. Should it maintain financial stability, which requires lower interest rates, or should it attack inflation, for which its recipe is to jack up interest rates? I'm not recommending it as a recipe. Robert Solow said that doing what people like Paul Volcker did back in the late 70s and 80s was burning down the house to roast a pig. Now, of course, Powell cannot afford to do that. Because remember, last time, interest rates only had to go up to about, I think, 5.25% before they pricked the housing and credit bubbles in 2008. And today they are at roughly that level. We have an even bigger so-called everything bubble. So if he raises interest rates further, and we've already had financial problems going back to certainly the commercial real estate and the bank failures in spring of 2023 and so on. So in a certain sense, you might say that there is already an ongoing financial crisis. So all of these things form very serious restrictions and hard parameters within which the Federal Reserve can act.
So Kathleen, of course, you basically said that it's almost like up to the Federal Reserve to do something, to rein in probably the spending or to solve the problem. What about the political leaders? Do you see any possibility of the two parties, each administration or next new administration will do something about that, especially on January 1st, the debt ceiling conference?
I don't believe it. I think the United States system broke in terms of accountability in 2010 when the US Supreme Court decided a case called Citizens United that decided that corporations, non-governmental organizations, special interests could all give unlimited money to politicians. And that opened the floodgates for basically oligarchs acquiring the US government. And if you look at the political money that's gone into US campaigns, it's skyrocketed since that decision. And unfortunately, that means that the oligarchs become the target of each campaign. And what we have in the United States now is both candidates promising tax cuts, targeting different segments of oligarchs. And the public interest, and for that matter, the interest in global financial stability, don't really make a difference. So I'm not sure how we get back to accountability. We have the same problem here in the United Kingdom, by the way, where in the last election this summer, nobody ever raised compliance with campaign finance rules because no party has an interest in it. So even though there were multiple violations, nobody complained because they're all keen to get the money. So it's I think, a very difficult challenge to get the system back to where it was before 2010.
Seems it's not only an economic issue, but also a political problem. On that note, we come to the end of today's show. Sorry to cut you off there, Kathleen. No. Many thanks to all of you. And also for our viewers, you can also watch us on the CGTN app on YouTube. Thank you for being with us. I'm Xu Qinduo. See you next time.